I'd like to use IUL for tax-free growth, but what if I'm uninsurable? Welcome back to episode 17 of our Secrets to Tax-Free Growth series. My name is Daniel McCluskey. I'm an industrial engineering graduate from the University of Illinois with a track in econ and finance, turned entrepreneur dedicated to helping you take the stress and worry out of your finances so you can focus on what matters to you. If you haven't seen the earlier episodes of this series, the full link is below. I recommend you do that. Now, oftentimes, a lot of people are looking into using a strategy like an IUL to accumulate money tax-free, to access their money tax-free, to pass on to their heirs tax-free, but they run into the problem of, well, I've had cancer in the past. Well, I'm overweight. What if I'm uninsurable and I want to use this strategy? Is it still an option? So today, very quickly, we're going to go over two things. Number one is that, well, you might not be uninsurable. I'll kind of walk you through that. And then two, there's going to be 5 different parties to an insurance contract. The owner does not necessarily have to be the same as the insured. We see this all the time, so let's get into that now. Number one, very simply put, is just that you might be insurable, although you don't think you are. Just because you've had a heart attack or you've had cancer does not mean necessarily that every insurance company is to decline you for the rest of your life. A lot of times what you're gonna do is, in these cases, people think, you know what, I'll just give it a try. I know it's not gonna work. I'm gonna be a doomsayer, but I'll submit the application and see what happens. And what you'll want to do in these cases is do a fully underwritten application. You're going to do this for almost all of them anyways, but specifically in these, you want to make sure you do that. So they're going to come in, they'll do a paramed, they'll do a blood analysis, a urine analysis, whatever it might be. And then in these cases, you'll also be able to write what's called a underwriting cover letter. So for your higher net worth clients, you'll also be writing a financial cover letter, kind of about all your assets and that stuff. Similar thing here, but on your health. So if you are someone who's had all of these past episodes or isn't quite the healthiest in the moment, but you're eating healthier and you're going to the gym and these are things that you've really been doing and have been doing for quite a while, the underwriters actually will consider these things. So you just write a cover letter and hey, even if they do come back with a decline or maybe it's a lower rating than you expected, you actually are able to contest this. The thing is, to do that, generally, you're going to need help from the agent or from their connections. A lot of time with certain IMOs, that's what actually hires the agents to sell under. They'll have connections with some of the underwriters at certain companies. And sometimes they'll be able to say, hey, look, can you really take a second look at this one? This person is convicted. They are much healthier, even though they had a heart attack or whatever it might be. And we really do think that they could get not only just approved, but even a preferred rating. Would you take another look at that? And they will, and a lot of times you really would be surprised. They do approve people. They are willing to work with you and take in all of those day-to-day factors and how they live very seriously. Second, we actually mentioned this in one of our very early episodes, but there was 5 parties to an insurance contract. So that is the insurer, so that's going to be the insurance company, the insured, so that's the person who actually does need to be insured. Then there's the owner. He's the person who owns the policy. If he wants to change the beneficiary, it has to go through the owner. If you want to take a policy loan, for example, to access your money tax-free, the owner can do that. Then there's the beneficiary, so who the money goes to. And lastly, the payer, the one who actually pays the premiums, puts money into the policy. Now, a lot of people, and most of the time, the owner, the insured, and the payer are all going to be the same person, but they don't have to be. In the case that someone's for sure not insurable, or they've at least tried to be insured and they've gotten declined, there's nothing they can contest, then in these cases, you're still not ruled out. The simplest fix to this usually is going to be if you have a spouse, using them as the insured, if that's going to be a better fit, using your parents, depending on your age and how old they are. Now, if your parents are 90, it might be different than if your parents are 60. And if you're older, for example, let's say you are the one that's 60, 65 years old, well, and your kids are grown up, then you can use your kids as well. You can use your kids even when they are younger, but it's going to be much harder to justify a very high amount of insurance for income replacement or estate preservation for a 5-year-old than it might be for a 30-year-old. Sometimes the owner may even actually be insurable, but they'll go ahead and use the spouse as the insured because maybe they're going to qualify for a better rating. Women tend to live longer, so this is always something you can consider if you did want to submit applications for both and see which one gets rated higher. Not necessary, but just something to consider. But that's the gist of it. Number one, if you are uninsurable, are you really? Let's go ahead and check. Let's make sure you actually are. And hey, if you are uninsurable, you are not ruled out. We've even had scenarios where someone is a US citizen, but they reside in another country and they couldn't be in the state that the policy was going to be issued at the time of signing because maybe they're out of the country 10, 12 months a year. I've even seen cases where it's the spouse is the insured, their mother is the owner, and then once the policy is enforced, they become a joint owner. The point is there's a lot of ways to get this in place for you if you're insurable or not. Next video, we are going to go into if all of this is true, if I can have this tax-free access, the tax-free growth, tax-free transfer, the protection from the losses and the market-like returns, why didn't my advisor tell me about this? We'll see that in the next video.